Hi, this is Bruce from Turnaround Stock Investing, a community of value investors devoted to helping you find, buy, and manage a portfolio of turnaround stocks. Today we're going to be doing analysis on Cloud Peak Energy, symbol CLD. However, before we do this, I want to mention that Turnaround Stock Investing is not an investment advisor. The content we will be providing for you is for educational purposes only. It is your sole decision as to whether an investment in Cloud Peak is a good decision for you. Please see our disclaimer at Turnaround Stock Investing and the disclaimer at the bottom of this page. We are now looking at a stock chart for Cloud Peak Energy from 2009 to the present. Cloud Peak was spun off from Rio Tinto in 2009 and thus began trading as a public company. As you can see, since 2009 till about this point in late 2014, the stock traded in a range from $14 to $23 a share over the past 5 years. Starting in 2014, the share price began its precipitous decline as thermal coal prices worldwide and natural gas prices in the United States began to decline significantly. We will be coming back to examine the technical analysis of Cloud Peak, but right now I just wanted you to see what has happened to the share price over the past 6 years before we begin our financial analysis. Cloud Peak is one of the largest producers of coal in what is known as the Powder River Basin. The Powder River Basin is located between Montana and Wyoming, as you can see here. Cloud Peak mines approximately 80 million tons from 3 surface coal mines within the Powder River Basin. You're now looking at a comparison analysis of coal versus gas that electric utilities will constantly run to determine whether they should generate electricity with coal or gas. Many investors not familiar with the coal industry will think that it's the Obama administration that has hurt the coal business. However, that is not the fact. The significant decline in natural gas prices has made it much more profitable for electric utilities to burn natural gas rather than coal. And this is the reason that Cloud Peak's price has declined so significantly. So let's examine this comparison that was actually prepared by Howard Weil, as we can see here. An electric utility will take 2 analyses, dark spread and spark spread. Dark spread is if they burn coal, and spark spread is if they burn gas to produce electricity. Right now, an electric utility will receive in the open market about $25 a megawatt, which is located right here. The cost to purchase Powder River Basin right now on a spot market basis is about $10.25 a ton. To transport that coal to the electric utilities that burn it is about $25 a ton. Other costs associated with burning this coal can be seen right here, which is about a penny. So it gives us a total cost per ton of about $35.26. We're now going to convert this cost per ton into MMBTU so that we can make a comparison to what it would cost to burn natural gas. So we can see now that if an electric utility were to burn coal, it would cost them $2 an MMBTU versus $2.02 to burn for gas. Now, that would indicate there is an advantage for Powder River Basin over gas. However, electricity is produced in different types of generating plants. In this case, you can see, and we won't go into the details, but it takes more energy to produce electricity with coal versus natural gas. And as a result, right now, if an electric utility burns coal, it will basically cost them $20 versus $15 for natural gas. And as you can see, it is more profitable to burn natural gas than coal. Their gross margin is $10 a megawatt versus $5 a megawatt. And this is the reason that Cloud Peak's price has declined significantly. We're now looking at another slide from the Howard Weil's Coal Weekly Update. And as you can see, the spot price for Powder River Basin coal is now $9.25 a ton. In our previous illustration, we were at $10.25 a ton. So the gross margins for electricity producers to burn natural gas has gone higher over the last few weeks. Now, the spot price for Powder River Basin really depends on what's going on with natural gas, and we'll talk about that next. Given the switching ability of utilities to go between natural gas and Powder River Basin coal, Powder River Basin prices are based on where natural gas prices are. And as you can see, since 2010, Powder River Basin pricing has gone from basically $14 in the third quarter of 2010 to $10.61 here. And as we can see, the spot prices have gone even lower. Natural gas prices are at all-time lows, recently hitting $1.76 an MMBTU. We're now looking at a presentation which shows us where the various coals would be on an equivalency basis. So for instance, if natural gas prices were trading at $3.66 an MMBTU, it would equate to Powder River Basin being priced in the spot market at around $11.25 a ton. And if natural gas prices were $4 an MMBTU, Powder River Basin pricing would be about $13.25 a ton. I'm showing this to you so that you begin to understand how the economics of Cloud Peak are driven. We will next be going over to see how Cloud Peak's operating margins are determined based on these various prices for Powder River Basin. So now that you understand how Powder River Basin pricing is determined, you can really understand what drives Cloud Peak's stock price. We're now looking at segment results from the 10Q of Cloud Peak Energy's September 30th, 2015 results. And as you can see here, for the 3 months ended September 30th, 2015, Cloud Peak received $12.62 a ton for each of the tons it sold on the market. In the previous illustrations we did, we know that Powder River pricing was $9.25 a ton in the spot market. Now, over the last week or so, natural gas prices have risen, so probably the spot market for Powder River Basin is probably back to $10 or low $10 a ton. And as you can see, that is a significant decline from what they received in the 3 months ended September 30th. I'm going through all of this analysis to show why Cloud Peak stock has declined so significantly and has not stopped falling. For every $1 decrease in Powder River Basin pricing on an annual basis, the EBITDA for Cloud Peak declines by $80 million. I'm pointing this out because previously we know that Powder River Basin pricing is assuming $10.50. Let's even assume $10.62 a ton. That's a $2 difference between what they received in this quarter. $2 a ton times 80 million tons is the potential loss of $160 million in incremental EBITDA. Next, I'll show you why that is such a large amount of potential loss for Cloud Peak. We're now looking in the same 10Q at the adjusted EBITDA by segment. And as you can see, for the 3 months ended September 30th, taking out various adjustments for derivatives that they have, they basically generated $50 million in EBITDA from operating their mines. Now, we're not focusing on logistics segments. We're just focusing on mine profitability. So that's $50 million, let's call it EBITDA, for the quarter. In our previous example, we showed that based on current PRB prices, there's the potential swing of a negative $180 million on an annualized basis. Right now, we're generating $200 million in EBITDA from Cloud Peak's mining operations. So if natural gas prices stay where they are over the next year and a half, it's possible that Cloud Peak's EBITDA from this segment will go to zero, and thus the decline in Cloud Peak's price. To add more misery to Cloud Peak, let's take a look at their logistics segment. And basically, Cloud Peak exports coal to South Korea and other Asian nations. Given the huge decline in thermal coal prices around the world, it no longer makes sense for Cloud Peak to export this coal. However, the company has contracts with various ocean-going companies and railroads to export this coal. It's known as take-or-pay contracts. And these take-or-pay contracts are significantly hurting the profitability for this segment. You can see here that the company lost $22 million in this segment, not because of the loss on shipping the coal, but because of the obligations that they had to the transportation companies to pay, even though there was no coal going out. So for the quarter, we saw that the company generated, and let's talk in EBITDA terms, $50 million, but lost $20 million in the logistics segment, netting out between $25 to $30 million in EBITDA if we consider various other adjustments. If we go back and look at where Powder River Basin price is now, the company, on a go-forward basis, has the potential to start suffering negative EBITDA, and thus the significant decline again in Cloud Peak's price. Now that we have an idea of the potential for negative EBITDA, let's consider when that will happen. We're now looking at another slide from their last earnings call presentation, and we can see that for this year in 2016, Cloud Peak has contracts to sell 57 million tons at $12.95 a ton. So even though PRB pricing is now, let's say, $10.50, they have contracted for 57 million tons at $12.95. If they sell 80 million tons in total in 2016, the balance, I'm assuming, will probably be sold, taking pricing right now, let's assume $10.50, which will give them in 2016 an average blended price per ton of $12.20. We're now going back and looking at the previous slide, and we can see that for this quarter, the company received $12.62 a ton. So let's assume now that the logistic losses stay where they are, and let's assume that the Cloud Peak business stays where it is and mines 80 million tons. I'm estimating that the potential EBITDA for 2016 will be around $110 million in that vicinity. We're now looking at another slide in the company's last earnings presentation where they're giving guidance for what EBITDA will be in 2015. And as you can see, they're estimating between 115 and 135 million. From that, you're going to take net interest expense of 45 million and capital expenditures of 40 to 50 million. And then they had a final lease payment to the federal government of $69 million. If you sum up all of those adjustments, and not including changes for working capital, the company will probably generate a cash loss of $30 million in 2015. Now we're looking at Cloud Peak's balance sheet as of September 30th, 2015, to gauge this loss and see how hurtful this will be to the company. We can see the company has currently a cash balance of $123 million, and this is after that $70 million lease payment to the federal government. The company has $1 billion in stockholders' equity against $490 million in senior notes. The company also has $167 million in obligations to return coal mines after they've done mining. And you can see here post-retirement obligations of $55 million, other liabilities of $12 million. However, I am primarily focused right now on the senior notes as compared to stockholders' equity, as this asset retirement obligation is a very long-term obligation. And as you can see, this debt to equity percentage for a coal company is quite good. We're now going to another presentation slide in the company's last earnings report. I'm using this slide to indicate when the $500 million of loans that are on the balance sheet come due. And as you can see, $300 million come due in 2019 and $200 million come due in 2024. This is significant because it means that the company does not have large principal payments coming due this year or next year or the year after. The slide also indicates that at the current time, the company has a lot of availability. They have $500 million available in the revolver, and they have $45 million if they securitize their accounts receivable. So combining those two with cash, they have $669 million in availability, a substantial amount given the size of the company. Despite all of this strength, the share price as of this week has broken to new all-time lows of $1.80 a share. And I believe that is due to where natural gas prices currently are. The markets realize that if natural gas prices don't improve, Cloud Peak is looking in 2017 at potentially negative EBITDA. And with this negative EBITDA, the company could possibly lose access to the credit facility we were just highlighting. As you can see here, the financial covenants under the credit agreement require the company to maintain a ratio of EBITDA for the preceding 4 fiscal quarters of 1.50 to 1 EBITDA to net cash interest expense. And of course, this could be the reason that the stock is falling, as the markets are anticipating the potential to lose access to this credit facility in 2017. As of the close of January 8th, Cloud Peak right now has a market capitalization of $112 million. It has an enterprise value, which includes the market cap, plus the debt, the long-term debt of $500 million, minus the $130 million in cash, of $478 million. Now, if you compare this $478 million against $150 million or $110, $120 million in EBITDA, this is a very attractive investment. However, this is a snapshot as of right now, and assuming natural gas prices go back to $3.50, $4 an MCF. So an investment in Cloud Peak is really based on your belief as to what happens if natural gas prices. If you believe that natural gas can go back to $4 or $5 an MCF, you are looking at what can be a multi-bagger return. If the stock market became comfortable that natural gas prices would stay at that level, I'm estimating that you could have an enterprise value for Cloud Peak of $1.2 billion and a market cap of $800 million. I arrive at this by assuming that the market would price a $200 million EBITDA for Cloud Peak at a 6 multiple, thus $1.2 billion. Then take out the $400 million in liabilities and long-term debt, net of cash, leaves us with an equity market capitalization of $800 million. That is versus the $112 million we are looking at right now. If we assume there are 62 million shares outstanding, divided by $800 million market cap, you're looking at a stock price of close to $13 a share versus $1.84. This is the reason Cloud Peak is on our watch list. To learn if we will enter into a position with Cloud Peak and under what circumstances, please become a member of Turnaround Stock Investing.